Financial markets and politics hate each other. Financial markets want politics to get nothing done. They want a split Congress. They want a split presidency with the Supreme Judicial Branch. They want everything split. And the reason, it's not because it's conspiracy or anything like that. They want it split because things can't change. It's very hard to pass bills or change big, dramatic things when there are splits in our legislature, okay? Right. So that means that they can predict what might happen. Stability. Well, right now, we have a lot of Republicans in power with the last election. And again, I'm not getting into politics, but financial markets hate that because they can't predict what's going to happen.
Right.
We couldn't predict the tariffs. We don't know. We knew he was going to do it, but we still don't know the effect of the tariffs, the long terms, the short terms. Is it good? Is it bad? Nobody knows. So stability. That's number one. Once we start seeing that, that will help bonds. Okay. Right. Interest rates, mortgage rates are developed from the 10-year Treasury. That's the best way to look at it. Okay. And when more people buy treasuries, the 10-year Treasury, rates go down, mortgage rates go down. When you sell off the Treasury bonds, okay, that's when rates go up. So it's very simple, okay? You want to buy a bond, and there's a yield on that bond, right, Mike? So stop me if you don't follow. You want to buy a bond, and they're offering a 4.5% yield or return on your purchase, right? Well, if a bunch of people are buying bonds, they're going to lower the yield. They're not going to pay as much interest because now buyers are a dime a dozen, right? Okay, but if people are selling off their bonds, they're going to raise the yields to entice people to buy them.
Yeah.
So when the Fed lowers interest rates, this has nothing, and I mean no offense, it has nothing to do with mortgage rates.
Right.
Mortgage rates are derived from the 10-year Treasury bond. So a lot of times what happens is the Fed are lowering rates, people start selling their bonds because now the rates are going to be lower than they're being offered.
Right.
So what happens is everybody calls and says, oh, I heard the Fed lowered the rate 0.5% or 0.25%. Where's my mortgage rate? No, your mortgage rate actually goes up when the Fed lowers rates. Now, that's temporary. I don't want to scare people. It's temporary.
And a lot of times I know the mortgage rates might fall just before the Fed does a cut.
Because they have the smart investors, so to say, and the people who are all in this and day trade this, they know the dip is coming.